Welcome to Financial Insights in Minutes, where we break down the latest in stocks, real estate, and the economy. Are we on the brink of disaster?
Experts like Danielle DiMartino Booth and Steve Hanke predict serious trouble ahead.
Get ready as we provide summaries of today's top videos to save you time and keep you informed.
Don't miss out. Your financial future could depend on this information.
And stick around for the end, where we'll summarize the points of agreement and disagreement among our experts. First up, Danielle DiMartino Booth discusses the looming economic collapse. Next, Ron Paul dives into the U.S. debt crisis and a so-called judicial coup. Then, Michelle McCory unpacks the powerful WEF 2030 agenda. Brian Kim explores the psychological dangers of money dysmorphia. Jeff Snyder breaks down the bond market upheaval. Steve Hanke shows why a recession by 2025 is almost guaranteed. Michael Silva warns of upcoming stock market volatility. Finally, Matt breaks down Tesla and Google's disappointing earnings. Welcome to the Danielle DiMartino Booth channel on YouTube. Today, buckle up for a riveting analysis from a true insider, Danielle DiMartino Booth. If you think you know what's going on with the U.S. economy, think again.
Absolutely. Danielle goes deep into some hard-hitting issues, from food bank lines doubling to massive job layoffs across industries. You won't want to miss this.
So, Danielle, what's the big headline here? What's she forecasting?
Danielle's core thesis is that the U.S. economy is not just facing a recession, it's on the verge of a catastrophic downturn. She predicts that within the next few months, we could see massive layoffs, financial instability spreading, and general economic chaos.
Let's break down those key points. First up, economic instability. What's the scoop?
Danielle highlighted the shocking increase in food bank usage. Tampa, Florida saw a jump from 20,000 to 40,000 families per month. And the layoffs? They're accelerating, and not just in Silicon Valley, but across all industries.
That's grim. How about the real estate front?
It's a real mess. Pandemic-era bidding wars have driven prices sky high, but now mortgages are unaffordable and financing has dried up. Sellers are in panic mode, especially those who got a little too speculative.
Got it. And let's talk consumer debt and fraud.
We're seeing massive defaults on loans and mortgages, plus fraudulent PPP loans. This all delayed the recession, but it can't hold off the inevitable. Americans are taking multiple jobs just to make ends meet. It's unsustainable.
Corporate layoffs seem ruthless. What stands out there?
Corporations are slashing jobs left and right, driven by shareholder demands. The polite layoffs with generous severances of 2023 are over. 2024 will see brutal, rapid cuts.
All right, it's crystal ball time. What does Danielle see coming?
She predicts that the recession will deepen, officially or not. Also, she suggests that political maneuvering might delay the declaration of a recession until after the 2024 elections, potentially complicating a potential Trump win.
Wrapping it up, what are Danielle's final thoughts?
Danielle calls for strategic caution and more transparent economic policies. She criticizes current Federal Reserve strategies and emphasizes the need for consistent methodologies to navigate these stormy waters.
Welcome back, everyone. Today on the David Lynn channel, we've got a riveting interview with Ron Paul. Hold on to your seats. We're diving into U.S. debt, an assassination attempt on Trump, and what Paul calls a judicial coup. Intrigued?
Absolutely. Ron Paul brings his A-game, dissecting everything from economic manipulation to shady political maneuvers. Former congressman, presidential candidate, and Air Force flight surgeon, he's got quite the resume.
So what's the crux of Ron Paul's argument here? Why is he calling the U.S. bankrupt?
Paul argues that the U.S. is not just facing financial bankruptcy, but also moral collapse. He highlights the role of powerful, unseen figures manipulating economic and political systems, essentially driving the country into a deeper crisis.
First up, let's talk about Joe Biden stepping out of the race. What's Paul's take?
Paul is skeptical about the official reason, mental health, and questions who's been running the show if Biden is unfit. He implies there are powerful people behind the scenes pulling the strings.
Now, what about the Trump assassination attempt? That's pretty intense.
Big time. Paul suggests the Secret Service's incompetence might be a cover for something more sinister, likening it to the Kennedy assassination. He believes a few key players could manipulate the system to their advantage.
All right, Shifting gears, what's he saying about the economy?
Paul slams the constant manipulation of the economy, especially through interest rates. He suggests a return to a gold standard to end this cycle of manipulation and artificial control.
Let's get out the crystal ball. What predictions does Ron Paul make?
He predicts severe economic instability, including the threat of hyperinflation. He also foresees a growing mistrust in governmental institutions, prompting a surge in support for libertarian ideals.
Wrapping it all up, what are Paul's final thoughts?
Paul urges the nation to confront its economic and moral bankruptcies now. He's calling for a return to sound economic policies and warns of severe consequences if these issues are ignored.
Welcome to Kitco News on YouTube. We're breaking down a topic electrifying global discussions, the World Economic Forum's 2030 Agenda. And who better to help us navigate this complex issue than the insightful Michelle McCory?
Absolutely. We're talking about why this agenda has many folks concerned, who the key players are, and why their influence is so pervasive. Trust me, this is a deep dive you don't want to miss.
So Michelle, what's the core thesis here? Why should we be paying attention to the WEF's 2030 Agenda?
The central thesis is that WEF's 2030 Agenda, far from being a conspiracy theory, outlines plans that could radically change global norms and potentially erode individual freedoms and national sovereignty. Klaus Schwab isn't keeping this a secret. He's quite open about it.
All right, let's unpack the key points. First up, who is Klaus Schwab and what's the backstory of the WEF?
Klaus Schwab founded the WEF in 1971. Originally called the European Management Forum, Schwab has been tirelessly pushing his ideas, drawing in global elites every year at their Davos event. Imagine a mix of Bond villains and world leaders.
Interesting. And what's this about stakeholders versus shareholders?
Schwab's big push is for stakeholders to have a say, but unlike shareholders who invest capital or labor, these stakeholders don't take any risks. It's like showing up to a potluck with nothing and still getting a full plate.
Fascinating. So who's really in the WEF's inner circle, and why does it matter?
The WEF is a who's who of global politics and giant corporations. They've got folks like Justin Trudeau and CEOs from leading companies on speed dial. It's a network that's hard to ignore.
Wow, that's some serious clout. But how does this NGO have so much sway over governments?
Though the WEF is a non-governmental organization, it collaborates closely with the United Nations and has a stake in many governmental decisions. They're pushing their agenda through influential partnerships and initiatives like the Young Global Leaders Program. It's like non-governmental central planning.
All right, let's get out the crystal ball. What does the WEF foresee for the future?
They predict that by 2030, the U.S. won't be the top dog anymore. A few dominant countries will take over, echoing the fall of historical empires and reserve currencies. It's a global power shift in the making.
Whoa, that's huge. Any other big predictions?
Yes, expect to see heavy regulations purportedly for climate change and sustainability. Think less meat consumption for the greater good. It's all about control and influence disguised as benevolence.
Wrapping it up, what should our viewers take away from this?
The key takeaway is the need for scrutiny and proactive response. The WEF's plans could deeply affect our freedoms and sovereignty. Vigilance is crucial, as these agendas blur the lines between global governance and non-governmental influence. Stay informed and stay engaged.
Hey everyone, welcome to ClearValue Tax on YouTube. Today we've got a topic that hits close to home for many out there, money dysmorphia. Brian Kim is here to unpack this tricky subject for us.
Absolutely. Brian delves into what money dysmorphia is, why it happens, and how to tackle it. It's an eye-opener, especially in our social media-crazed world.
So what's the main message Brian's sharing with us today?
The core idea is that money dysmorphia is this warped view of your financial situation. It's often triggered by societal pressures, social media, past traumas, or economic crises. This condition can lead to some harmful financial behaviors.
All right, let's break down the points. Starting with, what exactly is money dysmorphia?
Brian describes it as not merely being unhappy with your finances, but having an unjustifiably negative view of them. You might be doing okay financially, but feel inadequate because you're constantly comparing yourself to the flashy lives you see on social media.
Got it. So what kind of behaviors does this lead to?
Oh, lots of unhealthy habits. Brian talks about overspenders who go into debt trying to keep up appearances, misers who pinch pennies obsessively, and workaholics who never feel like they have enough, no matter how rich they are.
Yikes, sounds like a real issue. How common is money dysmorphia?
Quite prevalent. About 29% of Americans struggle with it. Millennials and Gen Z folks are especially prone because of their heavy social media use. The pressure to flaunt a luxurious lifestyle online impacts them more.
So what's Brian predicting for the future generations?
He's particularly worried about Generation Alpha, the kids growing up now. If they're continuously exposed to materialistic content, it could distort their relationship with money even more. So parents need to keep an eye on what their kids are consuming online.
Wrapping it up, what's Brian's advice for dealing with money dysmorphia?
He emphasizes improving your financial literacy and stopping the constant comparison game. Focus on personal growth, educate yourself on basic financial principles, and remember, appearances can be deceiving. And of course, he invites viewers to subscribe to his channel for more tips.
Welcome to Eurodollar University, where financial insights and economic thrills collide. Today's episode, holy smokes, you won't believe what just happened to bonds. As always, our host Jeff Snyder takes us on a wild ride through the intricate world of treasury curves and consumer behavior.
That's right. Jeff dives into the escalating bull steepening on the treasury curve and what it means for our economic future. Hold on to your seats, it's going to be a bumpy ride.
So let's cut right to it. What's the big takeaway from today's video?
The core thesis is that a dramatic bull steepening in the treasury curve is underway, signaling increasing pessimism about near-term economic prospects. Rising unemployment, high-end consumers pulling back, and urgent calls for rate cuts are all pointing towards an impending recession.
All right, let's break down those key points, starting with what's happening in the market.
Treasury yields are falling, particularly short-term rates. This bull steepening is a telltale sign that the market fears an economic downturn is on the horizon. It's like the market's waving a big red flag.
And what about consumer behavior? What's the scoop there?
High-end consumers are scaling back, big time. LVMH reported earnings misses from reduced luxury spending, corroborated by trends at Target and Walmart. It's so serious that even high rollers are hunting for bargains.
So what does Jeff predict for the future?
He sees more global rate cuts as central banks respond to the increasing risks. The Federal Reserve is expected to cut rates, even though history shows they don't really help. Also, the bull steepening is a timing signal that recession fears are turning into reality. Brace yourselves.
Wrapping it all up, what are the key conclusions?
Jeff emphasizes the need for aggressive rate cuts by central banks to tackle the growing economic instability. While bull steepening benefits Treasury holders, it's a bearish signal for the broader economy, underscoring the serious recession risks ahead. Fasten your seatbelts. It's going to be a wild ride.
Welcome back to Thoughtful Money, folks. Today, we're diving deep into some compelling economic insights brought to us by the illustrious Steve Hanke, a professor of applied economics at Johns Hopkins University. Since his last visit, we've seen some wild rides in the market. Hanke has a knack for predictions, and today we'll break down his latest forecast. A recession by 2025 is almost guaranteed by the math.
Indeed, Hanke's expertise sheds light on the current economic landscape and what we should brace for in the coming years. His insights could be your best tool for navigating uncertain times ahead.
Let's start with the core thesis. What's Hanke's main argument based on?
It's all about the money supply. Hanke posits that the significant contraction we've seen is virtually ensuring a recession by 2025. He draws on Milton Friedman's quantity theory of money, stressing that inflation trends and economic growth follow predictable patterns based on changes in the money supply.
All right, break it down for us. What were the key points Hanke brought up?
Firstly, Hanke revised his inflation forecast. While he originally predicted inflation would dip below 2% by the end of this year, he now anticipates 2.5% to 3%, dipping to 2% or lower in early 2025.
Interesting. What about his global insights?
Hanke analyzed 27 countries making up 75% of global GDP. and discovered that inflation trends are directly tied to changes in the money supply, typically lagging by about 23 months. For instance, the US, UK, and European countries saw significant inflation spikes due to their monetary policies, while countries like India and China had more controlled inflation due to steadier money supply growth.
Hanke's been pretty critical of current monetary policy, right?
Absolutely. He argues that central banks, especially the Fed, are missing the mark by ignoring money supply in their models. He firmly believes inflation is a monetary phenomenon, dismissing non-monetary explanations like supply chains and oil prices as distractions.
Okay, let's peer into Hanke's crystal ball. What predictions does he make?
First and foremost, he predicts a recession by 2025, driven by historical trends and current money supply contractions. With a 23-month lag between money supply changes and inflation, this timeline seems inevitable.
And what about interest rates and market reactions?
Hanke expects bond yields to decrease as inflation falls, suggesting that long-term government bonds could be a smart trade in the near term. While the long bull market in bonds might be ending, there are still short-term opportunities to capitalize on.
Let's wrap it up. What are the big takeaways for our viewers today?
Hanke emphasizes the need for realistic financial strategies amidst the predicted economic turbulence. Investors should prepare for a recession by 2025, align their portfolios accordingly, and consider the implications of changing money supply dynamics. It's all about navigating these stormy seas with informed precision.
Welcome to another exciting episode on Figuring Out Money. Get ready because today's hot topic is why you might be flooded with stock market crash videos soon. Michael Silva is here to dissect the recent market chaos with deep insights.
That's right. Michael dives into some nail-biting market action and why investors are pivoting towards safety stocks like utilities and healthcare. Buckle up, we've got a lot to unpack.
So, what's the main message Michael's trying to send us in this episode?
The main thesis is a warning. Volatility is hitting hard, making investors scramble to safer bets. Michael breaks down market indicators and what we should brace ourselves for next.
All right, let's break down those key points. First off, that market downturn. What happened with the NASDAQ?
Big drops. The NASDAQ Composite and NASDAQ 100 nosedived by over 3.6%. Safety sectors like utilities and healthcare were in the green, signaling investors are in risk-off mode.
Wow, that's intense. What about historical context?
It had been nearly a year, 356 days, since the S&P 500 saw a 2% decline. The last time we saw this kind of streak was during the Great Financial Crisis.
Yikes. And there was talk about standard deviations, too?
Yeah, Michael dove into the math. A 4 standard deviation move, crazy rare. This shows just how unusual and intense today's market drop was.
Got it. Now, let's chat market indicators.
The indicators pointed to bearish sentiment. Net flows and convergence indicators predict more downside action, and growth stocks are getting hammered compared to value stocks.
What about the yield curve? Any updates there?
Definitely. The yield curve's deeper inversion and potential uninversion could signal market consolidation or further declines. Watch that space.
Interesting. And what should we keep an eye on in the upcoming days?
Big economic reports like GDP, personal income, and spending data are coming up. Plus, earnings reports from giants like American Airlines and 3M. These will add to the ongoing market volatility.
Time for predictions. What does Michael foresee?
Buckle up for more volatility. The massive spike in the VIX and the market's backwardation signals rough days ahead.
Any chance of a bounce?
Possible, but any uptick will likely be short-lived unless key indicators show a sustained shift. It'll be more of a hiccup in a downtrend.
Got it. And about that yield curve?
Further uninverting could pressure the S&P 500 following historical patterns. It's a significant indicator to watch.
What should we expect from company earnings?
Big names like Tesla and Google could shake things up with their earnings reports. Will they add to the volatility or offer some relief? Stay tuned.
So wrapping up, what are the key takeaways?
Michael's final advice: be cautious and don't get swept up in panic-driven crash videos. Keep a close eye on key levels and economic reports to navigate these choppy market waters.
Welcome to Trade Brigade. Buckle up. Today's market update dives into the chaos of the market bloodbath.
Absolutely. It was a rough day, led by significant drops in Tesla and Google due to poor earnings and missed PMI expectations. Matt's here to break it all down and offer some tactical trade strategies.
So, what's the core takeaway from today's meltdown in the market?
The main thesis is that poor earnings from Tesla and Google combined with missed PMI numbers led to a downtrend in the market, with Matt emphasizing that traders should be cautious about shorting at these low points.
All right, walk us through some of the key points Matt discusses in the market update.
First up, the market bloodbath. Both Tesla and Google had disappointing earnings, which combined with missed PMI figures led to a major drop. Plus, there was volatility in currency markets.
Wow, sounds like a perfect storm. What about the state of the SPY daily timeframe?
Here, the trend is officially down. We've cemented lower highs and lower lows, breaking through critical support levels around 547. Not a good sign for the bulls.
Not pretty. What does Matt say about counter-trend moves?
Matt advises caution with new money shorts. Situational shorts or intraday trades are fine, but for longer positions, focus on potential rebounds rather than diving into more downside.
What are Matt's predictions moving forward?
Expect short-term counter-trend moves where the market might attempt brief recoveries before heading back down. Particularly avoid new money shorts at the current lows.
And what about specific sectors?
There might be brief bursts of buying activity in consumer sectors, creating temporary long opportunities. It's all about staying nimble.
Wrap it up for us. What's the final takeaway from today's episode?
In short, significant downturn led by bad earnings and economic data. Be careful with new shorts, expect counter-trend moves, and stay nimble in this volatile environment.
Today, Danielle DiMartino Booth warned us about economic collapse driven by layoffs and dwindling financing.
Ron Paul emphasized the nation's moral and financial bankruptcy, predicting severe instability.
Michelle McCory broke down the WEF's influential 2030 agenda, raising concerns about global norms.
Brian Kim highlighted the mental and financial risks of money dysmorphia, especially in younger generations.
Jeff Snyder pointed out bond market movements that scream recession.
Steve Hanke's math guarantees a recession by 2025 due to money supply trends.
Michael Silva warned us about upcoming stock market volatility, and Matt broke down the market reactions to Tesla and Google's disappointing earnings.
While our experts share concerns about economic challenges, their opinions vary on the specifics.
They differ on the best safe investments and policy critiques, but agree on the importance of strategic financial planning. Stay tuned for more critical insights. Thanks for watching Financial Insights in Minutes for July 25th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.